Hello everyone, it has been a wild and crazy week with massive volatility in the stock market. In this video, I will cover on what just happened over the last few days and my thoughts for the weeks ahead. There will be some technical analysis for major tech stocks in this video too, so watch on to find out more. But before that, can I trouble you to help me with the YouTube algorithm by clicking on the like and subscribe buttons? Your small action means a lot to me. So what exactly happened last week? There is a fair bit of things to digest, so let's take a step back and break them down. On Wednesday, after FOMC's meeting, the stock market went on a godlike rally at the end of the day. The reason could be because Fed Chairman Powell shared that the Fed wasn't considering raising the interest rate by 0.75 basis point to curb inflation. For context and for laymen to understand, higher interest rate is bad for the market. So with this less hawkish comment by the Fed, buyers went on a buying spree about an hour before the market closed on Wednesday. Check this out, this was how nice and green the market was. Then, in less than 24 hours, the market took one of the biggest U-turns since the early pandemic days as it plummeted and gave up all the gains in the previous day. The selling on Thursday was relentless and brutal, leaving most investors puzzled and confused. And guess what? I found this interesting article where it says that retail investors net bought $2.6 billion worth of stocks and ETFs on Thursday. And all I can say is, my thoughts and prayers go out to you retail investors. Okay, just kidding. Anyway, I don't know how true the article is, and sometimes we need to take such news with a tablespoon of salt. But say if it's true, it means that the big players and institutions were on the sidelines after Powell's speech. As the old saying goes, news can take up to a day to digest, and probably the institutional investors recognize that a more challenging environment for stocks are starting to settle in, and therefore they are taking liquidity and money out of the stock market now. When liquidity reduces, volatility increases, so do expect more volatility ahead. They say don't fight the Fed, which I agree, and to add on, I would say don't fight the market makers too. As previously shared, let the market makers make the move first. Case in point, when they decide to pull the money out of the stock market, all your gains can be wiped out in less than 24 hours, trapping all the bulls in the process. This is what happened to the bulls who FOMO and entered the market right after the Fed's press conference. From another angle, some may also argue that Wednesday's action was due to the market makers bringing the stock prices high up to trap the bulls. To me, it's really anyone's guess. Different so-called investment gurus and experts can offer different perspectives, but most of the time it is to match their own thesis. When the market went up on Wednesday, they will claim that the market has baked in all the news, and since there was no surprise from Powell, the market naturally went up. But next day, when the market tanks and came falling down, you have another group of experts saying it's expected because of macro factors, etc. Okay, I think there's nothing wrong with these experts choosing a side. I usually just take these comments with a pinch of salt. But for those who claim that the swing from Wednesday to Thursday was expected, I would want to call them bluff, as I think it's almost impossible to predict this massive rally in the last hour of Wednesday trading day and the wild reversal on Thursday's opening. In fact, YouTuber Dave Lee actually made a very good video on these pundits or so-called experts. I will put the link in the description box below. Meanwhile, what I'm quite sure is that at this point, it seems like each week is getting crazier, to a point which some investors may be wondering, is it them or is it getting crazier out there? Don't worry, it's not you, it's the market. So stay calm and stay sane. Anyway, I usually don't do precise prediction as to whether the market will rise or fall on a particular day, or if a stock will reach a certain level by this date. To me, this is like gambling on a football match, where you predict the score of the match at the end of 90 minutes. I prefer assessing which team stands a higher chance to win the title at the end of the league, which of course it is still a kind of prediction and can still be wrong, but I believe that forecasts of a longer time horizon outweighs short-term prediction. An example would be I assess that Apple will continue to give solid returns in the long run, such as 5 years from now, but it is difficult to accurately predict whether Apple will stay above 160 or not in the next 5 days. Alright, that's too much of talking, but I hope some of my thoughts resonate with some of the viewers out there. Okay, now let's move on to the technical analysis bit. First up, Tesla. It has been creating higher lows in the short term, as you can see from the green line, which is a good sign, but it's not bullish yet. as the long-term trend is still showing lower highs and within a downward channel, as marked by the two red lines. Personally, I see sub 800 as one crucial support area that may be tested if the market goes further down. If 800 breaks, I think 743, 700 and 695 will come into the picture. Anyway, among all the various mega cap companies, I think Tesla shows the most promising growth in this challenging environment, which I think investors see it and are stepping in to buy when it dips. And this is probably the reason why the stock is currently consolidating around $800 to $950 range. Personally, I have stepped in at $880 as I've mentioned that $800 range is a good buy in my opinion. I also have cash on standby for further downside at below $850 and $700 range. For now, I believe buyers will step in before it hits $600 range. Moving on to Apple, the stock tried to break out of the downward channel but failed and went back in. As shared in my previous videos, the 200 moving average is a strong support at $159, and Apple is currently floating around this price point. As it closed on $157 last Friday, I am expecting it to retest $159 again in the coming weeks. We will then have to see if it can close above it for a couple of days. That's for the upside. In terms of downside, the next two support levels are at around $156 and $150. Below 150 is a good buying opportunity in my opinion. If it hits 130, I will load up even more. Meanwhile, I also wanted to take this opportunity to remind again. I have always shared not to chase a raging bull, and this is a perfect example. The stock went on a parabolic mode up and now it's back to where it was. Those who FOMO in are trapped at $170 range. Anyway, something positive. On a longer time frame stretching all the way back to November 2020, Apple is still on an upward trend. In my view, if the market wants to crash, they will have to take down Apple first. And to me, Tesla and Apple are the best buys under the current climate. For Microsoft, the head and shoulder bearish patterns showed on the weekly chart indicates that the neckline at around 270s range has offered strong support for the stock so far. On the daily chart, you will be able to see that the sub 270 has been tested 4 times since February this year, and it bounced up each and every time. Given the bearish market sentiment now, I expect 270 to be tested in the coming weeks. And if that breaks, do note that there are not a lot of candlesticks or support below. In a worst case scenario, it may head towards $200 to $220 range where the stock was consolidating previously. But for now, I don't see that happening yet. To sum this up, investors can consider entering at around 266 to sub 270 with a small amount, as that's where the 61.8 Fibonacci level is, together with the 270 strong support level. But if it goes further down, you can load up more of this discounted stock. Price levels for consideration would be $240, $215 or even $200. Okay, let's move on to Nvidia. It appears that there is potentially a bear flag being formed here. If this is indeed a bear flag, the stock will chop around the current range for a little while before heading further down as shown by the red arrow. But a quick disclaimer, this is not guaranteed and it really depends on the broader market. However, just by reading the chart itself, the current trend is looking bearish with this potential bear flag and also because it broke below the support level of $200. But to highlight, their earnings report is coming soon at the end of the month, and I am expecting their results to be not bad. So let's see if Nvidia can reclaim $200 and close above it for a couple of days to turn things around. But if the market tanks, watch out for $180 or even the next consolidation zone between 115 to 155. To wrap this video up, I just wanted to say that I remain cautious and hesitant about the stock market outlook in the weeks and months ahead. That said, the market is quite oversold now and I am expecting some form of rally soon before heading down again. The reason being the market is not about company fundamentals now, it's about sentiment and macro environment. But I could be wrong as the market could just rally to all-time high. I mean, who knows what will happen in the second half of this year, right? So anyway, what should we do if the market is so uncertain in the coming weeks and months? This is not financial advice, but I am adding more shares to my portfolio. In fact, I am already scaling in slowly bit by bit. Buy when there's blood in the streets. Remember this sentence? But in case you're wondering why don't I wait for more blood if I am of the view that there could be further downside? Well, my answer is what if I am wrong? I mean, experts and financial gurus can call the bottom wrongly, let alone me, a newbie in investing. So yeah, What if the so-called extreme bottom or crash doesn't come? Or what if it comes but I don't know where is the exact bottom, and I waited and waited, then the market recovered in a V-shaped manner. So you should have all these questions in mind when you craft out your investment plans. But of course, if the current sea of red is making you nervous and cannot sleep at night, feel free to stay out of the market, as health is always more important than money. Alright, that's all for this video. If you have found this video useful in your research or understanding of the current market, hope you can like and subscribe to my channel. Feel free to leave a comment below too. A thumbs up will be encouraging. Thank you.